Good afternoon, everybody. It is wonderful to be back, obviously, with Financial Partners. I've had a relationship with the CreditUnion for well over a decade. It's a great institution. Always thrilled to be here to be with you today. There's a lot to talk about, but for the older folks in the audience, I should probably remark, I don't know if you've seen your phone, but Ozzy Osbourne passed away this morning. Yeah, I mean, you talk about a legacy, and if there's any way you could describe our economy right now, it would truly be a crazy train. So, again, for the metalhead, former metalheads in the audience, you get that. But yeah, I mean, there's a lot to talk about, and I'm going to dive right in. Again, Beacon, we've been around for almost 2 decades now. I left UCLA back in 2006 and started Beacon, so hard to believe almost 2 decades. Besides doing my talks and doing forecasts for the economy, I have a whole group of smart folks who do impact studies and forecasts and all sorts of things. Whatever the range of goods or products we produce at the company, whatever it's about, the one thing I absolutely insist on, the one guarantee I make to all my clients, is that we're going to give you the most honest answer we can. That is to say, we're an organization that lets the data tell us what's going on rather than, shall we say, some pre-selected political opinion of what's actually going on. And I knew when that was going to be my motivating force for starting the company back in the day, and I knew that was going to be a difficult mission. But what I didn't appreciate was how much more difficult that was going to be in the next 20 years. And it's so interesting to me because what I've seen around us all the time is this greater and greater disengagement between what we think is happening in our world and what's actually happening in our world. And over the last few years, for those of you who have seen me talk before, I've had to lean in a little bit on that and talk a lot about this difference, why it's there, how it's skewing things, how it actually is an important part of the crazy policies we're seeing but put forward, whether it's in Washington, D.C., Sacramento, California, of course, in many of the city halls across the state right now. And when I come to these talks, I always start out by reminding you that there's really 2 parts to today's presentation, and you really do need to keep these things separate in your mind. The first thing, of course, is what we think is happening in the economy and what's actually happening in the economy. And the key here, of course, is when I was in grad school all those years ago, I was taught these were the same things. In economics, you're taught the rational agent model, which is a fancy way of saying that people supposedly internalize information, believe that information, and make decisions accordingly. But again, when you actually are out in the real world and you're looking at the headlines and you're looking at the things that people are concerned about, and you realize that that is not what's in the data, you start appreciating the gap between these 2 things and why it becomes an incredibly important part for not only understanding what's happening in our economy right now, but for understanding where the economy is going next. In the end, to be a good forecaster, you have to pay attention to narratives and reality because it's narratives that derive decisions. The decisions of consumers, the decisions of businesses, the decisions of our policymakers. But of course, it's economics that determines the outcome of those particular decisions. So you have to pay attention to both in order to have some sense of what's going on. And ultimately, good choices and smart policies start with the correct narrative. And as I like to put it, over and over and over, what I see are false narratives driving some really bad choices. And they are choices that in many ways is indeed threatening to our economy today. Now, with all that, I got, 75 slides because I sat in the car before walking in here and deleted 10, believe it or not. I have way too much information. I do want to have a nice opportunity for Q&A because this is a good size audience for that. And I want to hear more about what you're concerned about, what you're thinking about. I'm going to buzz through these relatively quickly. When we get to the end, there's going to be a QR code. So don't take photos or any of that kind of stuff. You can use the QR code, get a copy of these slides. You can peruse them on your own. But again, I do want to spend some time with you at the end, allowing you to ask some of the questions that will certainly arise over the course of what I'm going to do here. All right? So let's dive right in. Here we are about halfway through, a little over halfway through 2025. Donald Trump has been president for about 6 months now, and it has been an interesting 6 months. I'll tell you that, right? There's little doubt that Donald Trump said he was going to be reelected and he was going to go to D.C. and he was going to shake things up. And look, whatever you think of the guy, he has absolutely done what he's promised. He has shaken things up like crazy. And you can certainly see it, of course, in terms of the collapse in consumer sentiment we've seen over the last 6 months. Of course, the rising policy uncertainty. A lot of people wondering what is actually going to happen in D.C. And yes, over the last couple of months, here we go again. We're hearing all about the recession that's about to befall the U.S. economy. Yet again, numerous people said, just because of the tariffs, this is it. The economy is going to go into another downturn. Now, have we not heard this before, right? I mean, there was 2019, the real estate recession, which, by the way, never happened. There was the 2020 call of the pandemic depression, 10 years of debt. By the way, the U.S. economy was completely healed from the Great Recession by the beginning of 2021. There was a 2023 yield curve recession, which again, never happened. So when all the forecasters immediately start telling us we're about to hit a recession, I think it's okay for you to apply a little bit of skepticism to that particular call, as the case may be. In fact, all this reminds me of one of my favorite economic curmudgeons, John Galbraith, who quipped many years ago that the only function of economic forecasting is to make astrology look respectable. And, you know, at the beginning of starting Beacon, I was a little hurt by this quote. 20 years in, I understand exactly where he's coming from, okay? Now, by the way, I should also point out there were some other interesting forecasts that have occurred over the last year. Does anybody remember 538? Remember the mighty Nate Silver? This is Nate Silver in October of last year when he said this is the closest election of the century, and he gives Kamala Harris a 58 and 100 chance of winning. Still close, super close as the case may be. Well, of course, we know it wasn't close at all. This was a hard right move. Donald Trump won the presidency with a larger margin this time than he did back in 2016. And of course, the Republicans took the House and the Senate. And that was true even here in California. We voted down the $18 an hour minimum wage that was on the ballot last fall, which honestly, I didn't think our state would actually vote down a minimum wage. And we actually did, which says, yes, the nation absolutely across the board, even here in California, went hard right as the case may be. And by the way, this brings me to a new expression, which is the only function of election polling is to make economic forecasting look respectable again. So it's nice to have someone who's worse than we are as the case may be. Now, while we're talking about this recession supposedly about to hit the U.S. economy, there's a whole other economic narrative out there. Have you noticed the stock market is at an all-time high level yet again? Did anybody else catch that Bitcoin in particular hit 120,000 in recent weeks? $120,000 to the moon, right? To the moon. This kind of reminds me of Irving Fisher, you know, back in 1929. Stock prices have looks like have reached a permanently high plateau. Or it also reminds me of all these wonderful claims, say back in 1999. Does anybody remember the book Dow 36,000 that was written in October 1999? Stocks are now in the midst of a one-time only rise to a much higher ground. I always love these people who talk these things. By the way, that book was written by a guy named Kevin Hassett. Does anybody know who Kevin Hassett is? He's in line to be, he's one of the nominees for the next Federal Reserve chairman, okay? This guy. Interesting times we live in, to say the very least. And as for Bitcoin, let me show you another version of looking at Bitcoin. This is Bitcoin market capitalization. With the recent increases in Bitcoin's value, the market capitalization of Bitcoin is now $2.5 trillion. Let me repeat that. The market capitalization for this digital asset known as Bitcoin is $2.5 trillion. To put that in context, that means Bitcoin is now worth more than Google. So between you and me, while all our forecasters are telling us we're on the verge of a recession, all our financial markets seem to be screaming, bubble, bubble, bubble. And this is all connected in an odd sort of way. I'm going to tie this all together as we get through this. Now, with all that said, let's talk about what's happened over the course of this year. And you know, what's interesting is the last few years I've been fairly optimistic. I've said I'm not bought into all this doomsday worries about another recession hitting the U.S. economy. But I will tell you, at the beginning of this year, I did indeed raise my chance of a recession up to about 30% in the next 12 months. Not quite as high as the other economists did, but we are starting to worry. And yes, I've taken it down a notch in the July contribution we just did at the Wall Street Journal. But I think when I talk about the recession I'm worried about, I think it's a lot different than maybe the recession that a lot of other forecasters are worried about. And let me explain. First of all, things aren't nearly as bad as you think. In a very real sense, when you think about the economy that Donald Trump took over in the beginning of 2025, this was actually one of the healthiest economies, at least at the surface level, our nation has ever seen. Household and business finances are remarkably solid. Let me repeat that. Household finances are about as good as they have ever been, despite all the newspaper stories telling you the contrary. And of course, when it comes to all the policy changes in DC right now, most of what has been thrown out there is not going to stick, all right? And most of these policy changes are more than smoke than fire in the short run. And while we may be all in a tizzy over policy changes, they're not amounting to nearly as much as you might think in terms of potential shock to the economy. The one place we might suggest is a particular worry would indeed be the tariff situation, and that's still unwinding even as we talk right now. But you know, if tariffs land within what I call a relatively median band of reasonability, even like say 20% across the board new tariffs, believe it or not, that is not enough to derail the U.S. economy. We can weather that because we're not a very trade-dependent nation. So in a very real sense, can this economy handle a little instability? From this standpoint, the answer is absolutely. We should be able to weather this without that much of a problem. But you see, it's not that clean. Because at one level, the economy is better than you think. It's also worse than you think. Like I already mentioned, household finances are the best they've ever been. But they're the best they've ever been for all the wrong reasons. A household net worth is at an all-time high level for the reasons I just told you. We have a massive asset bubble ripping through the U.S. economy right now. And yeah, it is true that disposable income for American households is at a record high level right now. But that's because we don't have to pay for a couple $1 trillion of government spending on an annual basis. Household incomes were inflated artificially by $15,000 per household last year simply because we didn't have to pay for $2 trillion of federal spending. So in a very real sense, this sense of household wealth and prosperity is, of course, an illusion driven by massive government deficits and financial bubbles. And that is the weak thing. If anything, what you would say about the U.S. economy coming into 2025 is this is an overheating economy. In other words, it feels very much like the economy back in 2004 and 2005, when the economy back then was again in the midst of overheating. And like then, as it today, the source of funds to, if you will, finance that overheating is coming from the rest of the world in terms of an enormous growth in the current account deficit. Last year, this nation saw an inflow of $1 trillion of hot money that paid for half the government deficit. Well, that's the weak link in the chain. The real issue here boils down to the fact that we're having a grand old time, but we're doing so on the basis of borrowing trillions of dollars from the rest of the world. And when the rest of the world decides they don't want to lend that money to us anymore, watch out, we're going to have a problem. Now, what could cause a recession? The standard story is whether it's tariffs, whether it's an increase in taxes, whether it's a cutback in Medicare, this is the straw that broke the camel's back. You saw that CNN headline, households are on the edge and tariffs and uncertainty could push them over, right? No, that's not the situation. The real situation is, again, our economy is relying on the rest of the world for a tremendous amount of money. And if that flow of capital into the U.S. economy turns off, rates are going to go up and go up sharply, and that's going to create all sorts of secondary issues within our economy. Now, what I've said over the last couple of years has been very clear. Interest rates are not coming down. Guess what? They haven't come down. But it isn't just that they're not going to come down. If I have to look over the next couple of years, there's another spike in interest rates coming up, and that's going to hit the U.S. economy. It's going to hit the housing markets. Obviously, it's going to hit some consumer demand. But the biggest issue of all is how that's going to interact with the government deficit to make the government debt burden that much larger. And that's where, of course, the big problem is right now, the problem we're not really talking about. So where do we go from here, right? And look, things have calmed down since the first quarter of the year. And this would be a wonderful opportunity for our government to go, okay, it's time to cool things down. It's time to take a little heat off the burner, if you will. Let things settle down to a sustainable equilibrium. That means doing things like enacting policies to cool off the financial bubble, getting a grip on our federal deficit and starting to shrink that deficit by decreasing spending and increasing taxes. Well, none of that's happening. And that's the key. The real issue with the Trump administration is that they are trying to heat up an overheated economy. No, that's not new. Biden did the same thing for the last 4 years. Believe it or not, meet the new boss, same as the old boss. Politics in the United States have encouraged both policies to dive into populist politics, and both parties have been aggressively expanding the deficit. Biden did it through spending, Trump's doing it through tax cuts. However the case may be, is they are two sides of the same coin, and ultimately they are going the wrong direction. They're going to make the situation worse, and that means when the comeuppance does finally happen, well, it's going to be uglier. Now again, when does that happen? The honest to God answer is I don't know. I don't know. It could be a year, it could be 2 years, it could be 3 years perhaps. It's really hard to see. A lot of it is going to depend about how the U.S. efforts to, if you will, attack the rest of the world through tariffs and all sorts of other issues, how those are going to come back and affect these flows of cash coming into the U.S. economy. Right now, there's a lot of uncertainty, and I would love to tell you that, hey, man, we got 4 or 5 years, no problem. That's not the case. But we're still not at a point where the end is obvious. We still have a ways to go to see where we actually cross that point. All right, so again, lots to talk about, lots to think about. Let's dive right in and get through some of this data. Again, coming into 2025, the U.S. economy growing very, very well. Almost 3% growth in real terms. We did see the negative growth in the first quarter of the year. Two things drove that. A, in 2025, there's been a slowdown in consumer spending. And B, huge increase in imports, largely trying to get in front of potential tariffs. All that said, you come into the second quarter, and we've seen a little bit better numbers in terms of consumer spending. And of course, imports are way down since we imported everything we needed in the first quarter. And that result of that is we're coming up to the end of the month. We're just a week away from getting that Q2 number, and it looks like it's going to fall kind of in the 2.5% range. In other words, the U.S. economy is continuing to expand at this particular point in time. And of course, up to this particular year, consumers have been having fun, foreign travel at an all-time high level, lots of spending in restaurants. Las Vegas has been busy. Indeed, if you look at nominal spending growth through April of this year, the biggest increases in spending, nominal spending, have been on spectator sports, foreign travel, live entertainment, air transportation, and then membership clubs. Then you get a little nursing home, prescription drugs. On the low end of things, hotels, not a lot of new spending there, only up 1.5%. Higher education, 3.7%. Alcoholic beverages, 5.4%. We're all traveling and not going to school. Now, coming into this particular year, as noted, things have slowed down. You can see real spending has been relatively flat over the course of this year, but it isn't because incomes have been taking a hit. It's only because some of the uncertainty has caused savings rates, which were candidly way too low, to drift back up to something more resembling normality, something a little less than 5%. Overall, disposable incomes are continuing to grow, and in May of this particular year, not quite the highest ever, but still up substantially where they were. And remember, now we got all those wonderful tax cuts kicking in. Almost assuredly, there's going to be a nice boost in consumer spending in the second half of the year, and you're going to see the economy looking pretty good. Household credit, If you look at the data, we know there's been an increase in credit card delinquencies that seems to have leveled off, auto delinquencies that seems to have leveled off, overall debt to income ratios continue to drift down. Consumers are not borrowing a lot of money right now. Their debt loads are relatively manageable. I like to point out that if you want to look at the highest level of household distress, that would be bankruptcies and foreclosures, and those are still near record low levels at this particular point in time. And remember, most consumer debt is in the form of a 30-year fixed rate mortgage, probably something they refined back in 2020, 2021, and as a result of that, the actual debt obligation ratio, again, the share of household income spent on consumer debt still remains relatively low from any long-run perspective. Households look in good financial shape. Labor markets remain tight despite some of the uncertainties. The unemployment rate's 4%. The job openings rate is running about 4.5%. Overall job growth remains positive. Real wages continue to rise coming into 2025. This is hourly wage growth. Over the last decade, by the way, the bottom half of American workers have seen about a 17% increase in their real hourly wage compared to about 11% for the top half. So not only are real wages growing, despite all the headlines to the opposite, but at the same time, we've actually seen a decrease in income inequality in the United States. Has anybody seen that headline in the New York Times recently, right? Of course not. We don't talk about good news. Indeed, it's interesting how good things are. The official poverty rate right now is a little bit less than 12%, but the official poverty rate's not a very good number because it doesn't include a lot of the benefits that lower income households receive, including, for example, SNAP benefits, Medicaid, that isn't counted in that particular number. A lot of Section 8 housing isn't included in there. It's interesting. There is another measure of poverty that comes from the CBO that includes these adjustments of various sorts of ways. According to the CBO, the poverty rate in the United States is 0.5%. Most recent number, that's in 2023. 0.5%. So remember the war on poverty that was started in the 60s? We've won it once you look at the data appropriately. Now again, you don't see that in the news. You constantly hear about how poverty is this enormous burden on the U.S. economy. It isn't. Those numbers simply aren't true. And again, going back to income and income differences, women have been seeing in recent years more income growth than men, and lower skilled workers more than high skilled workers. So yet again, you see more equality in our economy. Business investment has been growing decently. It's been a bit of a mixed bag. We know that commercial and healthcare investments have slowed down a bit. Mining is down. Entertainment, of course, has slowed down a bit as well. But information processing equipment is up. Transportation equipment is up. Residential investment continues to grow strongly. Even manufacturing. A lot of stories about manufacturing right now. A lot of folks talking about the potential for onshoring. We know that a lot of the tariffs we're seeing that they want to put into place is to bring manufacturing jobs back to the United States, which I always find interesting since they're trying to throw out workers at the same time. But one of the things about manufacturing we have to keep in mind is actually they're not doing too bad. Employment's been kind of flat over the course of the last couple of years, but it's higher than it was, say, in 2015. Industrial production is actually at an all-time high level coming into 2025. And this doesn't really tell us everything. Take a look at manufacturing profits on the right-hand side here. Manufacturing profits are twice as high coming into the end of 2024 as they were prior to the pandemic, and real value added is also at an all-time high level. So overall, manufacturing companies in the United States seem to be doing pretty damn well. Construction activity has been, despite the big increase in interest rates, has remained relatively steady. It hasn't grown a lot, but given the fact that mortgage rates went from 2.5% to 7%, the fact that they're growing at all, I think it's pretty impressive. As noted near the top of the list there is residential investment. It is interesting. We all know it's a terrible time to be a real estate agent. There's very few home sales out there. If you happen to rely on mortgages to help your bank make some money, not a good time for that segment of the bank lending market, again, because of that big increase in interest rates. But that said, prices continue to rise. They've been a little flat this year, but they are still rising. And ultimately, the biggest problem we have in real estate is not the fact that there isn't an interest in buying, but rather there's no one who's selling. The real problem here is a lack of units, a lack of existing units that are being listed for sale, and of course, overall, because of a decade of weak construction, overall housing vacancy rates, although they are coming up just a little bit in recent months, is still near record low levels. This is still a housing market that needs more housing in it. Now, that's why, of course, new housing construction has remained relatively steady again, despite the fact that interest rates are high. It's a weird world. Typically, home builders and real estate agents, their lives are wonderful together or they're horrible together. And to see this kind of dichotomy between the resale and the new home market is very, very interesting. It's almost unique in U.S. economic history. But again, it all occurred because of that enormous increase in interest rates and the overall shortage of housing. Single family home sales, nice and steady, running a little less than 700,000 per year. Housing starts still running about 1.5 million, better than at any point in time from 2007 to 2019. Now, with all that good news, it isn't great news, because while it is true that builders can build, they're also suffering from a buildup of inventories. You look at the data, and there's actually been a sharp increase in units listed for sale, new homes. It's relatively high, and it's odd because they're still building, but there seems to be a lot of inventories. And it goes back to a basic idea in housing having to do with what they call filtering. One of the things that makes me a little crazy is this argument that, well, we don't build enough affordable housing. You've heard that, right? We don't build enough affordable housing. Well, that is an oxymoron, because builders don't build affordable housing. You build where the profit margins are the fattest, which is at the top end of the market. You build housing, right? And that said, if you build enough housing, it becomes affordable. It's a different conversation than what we hear. We don't build enough affordable housing. Now, the real issue here, though, is when you think about that filtering process, how does it actually operate? Well, it's okay if builders build at the high end. They build fancy new homes and fancy new apartment buildings, as long as there's liquidity in the market. So say you're in Dallas, where there's a lot of filtering. You build a brand new, beautiful suburb out in the hinterlands, big, beautiful 5,000 square foot homes. You slap them on the market, and a bunch of high-end Dallas folks move in to that housing. Well, they just left a formerly nice neighborhood, and by the way, people one step below them will move into that neighborhood, people one step before them will move into that neighborhood, and of course the entry-level neighborhood at the beginning of this cycle, well, that gets moved into by people buying their first home. That process is known as housing filtering. You build at the top to supply at the bottom. But remember, that process works because of the fact that you have lots of people moving through different stages of the market. Now, here's the issue with building homes right now. Remember all those people with a 2.75% 30-year fixed rate mortgage that you will pry from my cold dead hands, financial partner CreditUnion? This is a running joke. The issue here, of course, is that people are not willing to move because of the reset in interest rates they're going to face. And so as a result of that, builders have to deliver the product to where people want it. They need to start building entry-level units for that first-time buyer. And that's hard to do, particularly in California, when, of course, we know we have mountains of permits that are leveled on any kind of construction, whether it's fancy or more entry-level, as the case may be. And equivalently, you also have all the other controls on liquidity in the market that are slowing things down. So it's hard to be a builder, but you can still make money building the right thing in the right place. But again, the decline in liquidity is something we all have to think about and worry about, because liquidity is an important part of a healthy housing market. I'm going to come back to this point just a little bit later. Now, with all that said, the good news is, at least coming into 2025, inflation has cooled. Interest rates, after rising sharply, have steadied and indeed seem to be kind of drifting down just slightly, running a little less than 7% for a mortgage rate now. And it does seem as if people are starting to normalize to it. Now, also good news, the Federal Reserve has backed off of quantitative tightening, and bank deposits are starting to refill, and lending is increasing in these lending markets right now, and it's easier to get a loan. If you take a look at the Senior Loan Officer opinion survey from the Federal Reserve, there are now more people looking to get a mortgage loan, and of course overall standards for mortgage loans have become a little easier to get after the last couple of years. So even here you do see a light at the end of the tunnel, with credit a little easier to get, people are starting to normalize, and you do start to see a pickup in overall activity in the market, it feels like things are on a better path. There's no doubt about it. Now, with all that said, you are certainly not seeing it in the mood, in the national sentiment. I already mentioned the fact that the Consumer Sentiment Index from the University of Michigan is basically near an all-time low level. Gallup recently did a poll of Americans who are satisfied with their life. By the way, that is at a record low level in 2025. Never have fewer people claimed to be satisfied with their life right now, despite the fact that spending is at an all-time high level and debt-to-income ratios are near an all-time low level. Yet people are just not satisfied. You see headlines like this: 70% of consumers feel inflation outpacing income. I already showed you that data. Not true. And in fact, 7 out of 10 college students say the country's headed off on the wrong track, mainly because they just got a job offer from a company who said they have to come to the office maybe twice a week, maybe. And of course, one of the things that I continue to find just one of the silliest concepts ever, yet it's still out there. According to a recent survey, 74% of Americans think their kids will be worse off than they are when they grow up. And again, really? Has anybody actually looked at your children's lives and thought, wow, absolutely, this kid's going to have a worse standard of living than me? But this is the attitude. And this is where you really start to recognize that we have narratives of reality, and they just don't match. They are off base. And I've talked about this over the years when coming in, this idea that narratives and realities are separate from each other. Schiller wrote a wonderful book about this called Narrative Economics, where he says you got to pay attention to narratives, otherwise you remain blind to a very real mechanism for economic change. But he wasn't the first. Keynes, back in the day, said markets are moved by animal spirits and not by reasons. Well, he's talking about narratives. And of course, my favorite Southern California philosopher, Will Rogers, famously quipped, "It isn't what we don't know that gives us trouble, it's what we know that ain't so." And he's talking about false narratives. Yet, again, over and over, we recognize that false narratives are truly part of human beings, who we are, and how we see the world in very odd ways. And it's something we all do. It's so easy to go, yeah, all those people are completely disconnected. But we're all wired in this particular way. We really, truly are. Our fair state of California, again, every time you turn around, we're told how terrible things are in the state of California. And don't get me wrong, there's some worrisome things. We know a state has a $20 billion deficit right now. We certainly haven't seen the same kind of job growth that the rest of the nation has seen. Overall job growth since we got out of the pandemic has been relatively flat. California's unemployment rate has risen more so than the rest of the nation. And that's true here in Southern California as well. Consider this, Los Angeles basically has 0.7% fewer jobs today than it did prior to the pandemic. Orange County is exactly the same as 2019. They haven't grown at all. The nation has added about 4.6 jobs, and of course Phoenix is up 10%, Las Vegas is up 9.4%. So other cities are growing, but not here in Southern California. For whatever reason, job growth is absolutely stalled. We know, of course, that SoCal airport traffic has topped off. It's below where it was. Hotels still struggling, particularly around business centers, such as the airport, not doing well there at all. Tax receipts have been relatively flat, drifting down just a bit in recent years, still above where it was prior to the pandemic, but not growing very well, particularly, of course, when you think of Los Angeles, which is only up 15% from 2019. We know about the losses in tech jobs in the state at this particular point in time. And of course, the massive problems with office vacancies across the state right now. So I get it. There's plenty of things to look at in terms of California and go, that looks pretty worrisome. What's going on there? But with all that said, take a step back and recognize everything I just showed you, these are estimates of growth on what we call the extensive margin. How many new jobs are we adding to the economy? Well, I have a better question. How well are people getting paid? And on that front, thinking about intensive margin, growth in the intensive margin, well, California is still by far and away one of the most successful economies in the nation and really the world. Incomes are rising faster here in California. Median household incomes Worker incomes rising faster in California than most any place else in the nation. It's worth noting that while we're not growing as fast as we used to, of the 3,200 counties in the United States, no fewer than 11 of those counties in the top 100 in terms of incomes are right here in California. We are still by far and away the most expensive zip code in the nation. As for income inequality in the state, well, our poverty rate has come down more than the national average. This is the official poverty rate. It doesn't include all those benefits received. But however you look at it, it's very similar to national trends. It's down quite a bit. And Hispanic and African American households have seen more growth in their incomes than the overall average in the state over the course of the last 4 years. So yes, we're seeing more equality, more income inequality, equality in the state of California. Yet, of course, many of our policy organizations are absolutely going to convince you that things are getting worse, not better, despite the fact that the data tells us over and over things are in fact getting better. What's interesting is not only are we seeing, say, better income growth for Hispanic and African American households, but we're also seeing better income growth in areas that have typically had lower incomes. Some of the highest city incomes are in Stockton and Fresno and Long Beach and Bakersfield, typically blue-collar cities that we typically think of as being far behind the Bay Area. Yet they're seeing the biggest increases in income growth. The biggest decreases in poverty are places that have high poverty rates, again, such as Fresno, Bakersfield, and Stockton. Real wages here in Southern California continue to rise, particularly in the Inland Empire. You go back to 2019, in the Inland Empire, average weekly wage was a little less than $900. Today it's over $1,100. That's a over 25% increase in weekly wages out in the Inland Empire recently. And yeah, they've even continued to grow in Orange County. They're now above 1,300, so on and so forth. Poverty rates across Southern California down. The share of the population with a subprime credit score is still near an all-time low level. It's drifting up slowly, but still very, very low. Over and over, what you see is, yes, there may not be as much growth on the external margin, but the people who continue to live and work here in California seem to be doing fantastic. They seem to be doing very, very well. Why aren't we growing faster on the extensive margin? It's not complicated. Look, over the last 5 years, from the January 20 to January 2025, our state added about 386,000 payroll jobs. That's it. But remember, they did that on the basis of a labor force that only grew 120,000. That's the real problem here. How do you grow when your labor force is not actually growing? And of course, we don't build enough housing. That's why we don't have growth in our labor force. I'll show you one really depressing statistic. This is the one that worries me more than anything else. Texas versus California. In the last 5 years, Texas has added 1.7 million workers to their labor force. We've added 120,000. Why are they growing faster than us? There you go. It's not complicated. People would love to live in California, but we don't build enough housing. Simple as that. Ergo, we've constrained growth in the state, but that's our choice. It's not some external condition. And that's exactly why, when you look across the state, take, for example, the Inland Empire. In the last 5 years, the Inland Empire has been responsible by itself, those two counties have been responsible for a third of all new job growth in the state. And of course, the Central Valley, that's another third. So there you go, the center parts of the state. You throw in Sacramento, that's about a sixth. So basically, between Sacramento down to the Inland Empire, the Inland Empire State are responsible for almost all new job growth, whereas, of course, places like San Jose, Oakland, San Francisco, Los Angeles are actually below where they were 5 years ago, and that's because they've been losing labor force, particularly Los Angeles. Now, our lack of labor force growth is particularly profound. Los Angeles down 4% from pre-pandemic, San Francisco down 4% from pre-pandemic. Orange County has grown a little bit, 1.4%, but again, consider Fresno, consider the Inland Empire, consider Houston and Phoenix, and the U.S. overall. Yet again, we won't build housing, you can't grow your labor force. How is the economy going to grow? It's as simple as this. And we know it's a labor force constraint because while unemployment has drifted up slowly, it's still relatively low for any stretch of the imagination. And it isn't just that we're seeing a lack of labor force growth, but look at how it's being twisted. For example, young workers, that's declining in California right now, Southern California right now. Workers that don't have a high school degree or a high school degree, that's declining. Because these are the folks that are most hit by high housing costs and who chose to leave. Simple as that. Now, what about people leaving California, right? We all have heard how population growth, by the way, has steadied. It's coming up again. But yet again, we have fewer people now than a couple of years ago. But we have been building some housing. What's going on here? Well, again, the real issue here is how well Californians are doing. The story is home costs are so high, people are fleeing the state. But that doesn't make any sense, because if that was the circumstance, home prices would come down and housing vacancy rates would go up. People are leaving the state, but we have record low vacancy rates and home prices continue to rise to record high levels. There is something else happening here, and the answer is a big decline in people per household. We have seen an almost 10% decline in people per household in the state of California over the last 5 or 6 years, and that, of course, is driven by the fact that people who are living here are doing great. And when you're doing great, you want more housing. Housing is a luxury good. When your income goes up, you spend a higher share of your income on housing. That is what you do. Now, what does that mean from a practical standpoint? Well, that means I'm not going to live with my family. It means I'm not going to have roommates. It means families with kids, they're leaving, where singles who are less housing price sensitive are moving into the state. This is the swirl. This is the change that is happening right now, and that is particularly true here in Southern California. Take LA and Orange County. The population in Orange County has been flat for a decade. In LA, it's dropped by 2%. But it isn't because we haven't been growing the housing stock. It's up by 7.3% in Orange County, 8% in Orange County, 7.3% in LA County. But this is offset by the big decline in people per household. People are spreading out. That's what's pushing prices up. And the only way to solve this problem is A, destroy the economy so incomes go down so people don't spread out anymore. Or B, a better option is build enough housing. And of course, we don't build enough housing. And that's why home prices continue to go up. The home prices continue to be expensive in California because of the pressures of demand, overall demand on the housing stock. Now again, very little in the way of home sales. We know that interest rate problem is particularly profound here. And yet again, this becomes an enormous barrier to builders being able to build. You want to build at the high end, but because we don't have enough filtering, it becomes really complicated to do. And hence, we're having a tough time really filling things in. It's not an affordability conversation. I mean, don't get me wrong. There's some affordability issues. Don't get me wrong. But that said, what are we talking about? Well, the Inland Empire back in 2018, the median, the share of cost burden owners was about 40%. Well, today it's 40% as well. Despite the increase in interest rates, it hasn't gone up all that much. And if you look at new buyers, these are people who just purchased. Again, you can see the drifting up of median costs for new buyers. Take it LA, for example. In 2013, your median new buyer spent about 31% of their income in housing costs. Today, it's 36%. That's the interest rate increase that we're talking about there. So you see some pressures, but if you compare it to where we were, say, prior in 2007, the numbers still look pretty good. The real issue here is we're not building enough, and we're just, whether you're looking at permits at the state or permits at the local level, despite all the promises of the state to find solutions to our housing shortages, they haven't really leaned in. And even the CEQA thing, boy, everybody's so happy about the changes in CEQA. And yeah, I'm glad to see some of the changes in CEQA. But don't kid yourself for a second. Is that a game changer? Of course it isn't. A couple reasons. First of all, the new CEQA law, while it does limit CEQA for certain types of infill projects, we're not going to solve our housing shortages with just infill. We also need new subdivisions. And those are still, of course, going to get hit with all the CEQA stuff. And by the way, anything over 85 feet is a 7-story building. Anything over 85 feet, well, that still has to deal with CEQA. And guess what we need in our inner cities in particular is we need a lot more 10, 12, 15-story buildings. And again, that's relatively limiting as the case may be. And then some of the horrible things. that was in that package. Did anybody catch that according to the new CEQA law, now, anything that is considered to be an affordable housing project, any housing project that is quote-unquote affordable now has to use prevailing wages. Prevailing wages, of course, are not prevailing by any stretch of the imagination. Prevailing wages are a set of numbers, hourly rates for union construction workers that are approximately 3 times the market rate. So what we've decided to do in California is to make affordable housing the most expensive housing to build. And when it comes to housing and lack of housing supply, remember, it isn't just CEQA. It's death by 1,000 cuts, and CEQA's maybe 75 of them. We still have enormous permit fees. We still have planning boards. We still have the stubbornness of city councils who are anti-housing because housing brings them costs and not revenues. And we still face the absurdity of ridiculously inefficient bureaucracy. They just are starting to roll in some AI tools to hopefully speed up the permit process in the city of LA. I hope it works. I would love to see that because right now it's insanity. How hard is it to get anything permitted?
And then, of course, on top of all this, one more hit to Southern California was, of course, these horrible fires we saw at the start of the year. And these were absolutely tragic. They weren't quite as tragic as you would have thought. I mean, there were people saying, LA can't possibly live at scale. That's a little bit of an overstatement, to say the least. Look, you lost about 11,000 homes. Out of, if you think of Orange County and LA together, you're talking about 4.3 million homes. So we've lost 11,000 out of 4.3 million. That's not a big mouthful. We're okay on that. And in fact, when you just think about the number of units we built, Orange County and LA typically permit and build something between 25 and 30,000 units per year. So you think about 11,000 units, it's not that big of a number. Clearly, it's manageable from a flow perspective. That's not the issue. The issue is how fast can you build these things? And it's so interesting because we've gotten heavily involved in thinking about fires and rebuilding efforts. We've looked at a lot of different case studies. And you want to look at a place that did all the right stuff after a fire, go look at Sonoma and Napa after their Oral 2017 fires. Sonoma and Napa lost about 5,000 housing units out of 600,000. So not 11,000 out of 4 million plus, but 5,500 out of 600,000. So fortunately, a much higher number. Yet those economies did exactly the right thing. You know what they did? They said, we need to rebuild it. We need to rebuild rapidly. And what we're going to do is get the hell out of the way. We're not going to get involved. We're going to let people work together to create economies of scale. We're going to allow people to freely sell their land, bring in investors who know how to deal with this and build quickly. And they sped up the permit process. They guaranteed permits in 6 to 8 weeks. Guaranteed that. And it worked. They rebuilt remarkably rapidly. And the best part of that story is they continue to build at a higher pace than they were prior to those fires. So they learned their lesson, they did the right thing, and they continue to see growth. Will we get that? Well, at first I thought we might. It certainly backed off on CEQA thing, but then of course they moved in to prevent investors from being able to make offers on land. By the way, investors are buying land anyway. And again, I don't understand this. Why is it that in this state, somehow or other, anytime someone is buying something from somebody else, there must be, by definition, somebody who is basically being taken advantage of? There's no such thing as a transaction in this state where one person isn't being taken advantage of. It's being exploited. That's what it feels like. And it's nonsensical. Well, reality is the vast majority of people out there do not have the mental fortitude to go through the process of building a house. And if you're 70, you don't want to deal with this nonsense. If you have kids, you don't have time to deal with this nonsense. Unless you understand the bizarre intricacies of home building, you probably don't want to deal with this. So I would argue getting it sold up to investors as fast as possible is probably one of the best ways of rebuilding. But again, we don't have these conversations. Instead, we've passed rules against it. And they haven't truly gotten out of the way. It's still taking a very long time. And then, of course, we have the very sorts of laws such as ULA. Does everyone understand that what ULA is? Our management tax in the city of Los Angeles. It's an enormous tax on anybody who sells a property for over $5 million a year, for over $5 million. Now understand the consequences of that. Let's say you want to go into the Palisades and you're going to be an investor and you're going to build a nice fancy new house and sell it. You're going to do it rapidly and do it well and get that neighborhood rebuilt. Great, good for you. And guess what? At the end of that process, when you sell it, you now have to give a 5% of your gross revenue to the city of LA. That's an enormous tax. Let's say you were aiming for a 10% return on your investment. Well, guess what? You have a 5% return. And that will hold a lot of people back. Again, we need to promote housing liquidity in Los Angeles. We need to promote housing liquidity in California. And instead, when you talk about high transaction costs, the attack on popular listings, mansion taxes, Prop 13, rent control, all of these things reduce liquidity and make it harder for us to catch up on our housing need. We're moving the wrong direction. And even for example, rental markets. Look, apartment rents, I would do a little quiz first. Who thinks we have our rental prices on our hands? Raise your hand if you think we have a massive rental crisis. Come on, don't be shy. You can raise your hand. You know where I'm going here. We're going to tell you you're wrong. But that said, you've all heard it, right? And yet, when you look, what's happened to apartment rents over the last couple of years? Well, they came up sharply after the pandemic, but they've been flat for a couple of years. Median rent-to-income ratios are basically the same now as they were a decade ago. In LA, they're actually down a bit. San Diego, they're about steady. Orange County, they're about steady. Yes, rents have come up a lot, so have renter incomes. In fact, if you think about renter affordability, whether you're looking at the 15th percentile or the 75th percentile, you're not seeing a big change. There is no major change in our rent-to-income ratios. Not at all. And yet, we have a singular panic going on. In city halls, state level, there is a panic going on about renters. In fact, in many things, what's interesting about renters? Renters are just like homeowners. They're spreading out. Look at the big decline in people per renter household. One of the reasons that renter income to rent ratios haven't come down is because people are living alone more and more often. Do you know how many singles we have in Southern California who live in a two-bedroom apartment by themselves? Well, they're paying 40% of their income on rent. They have a huge problem on their hand. Yeah, if they had a huge problem, get a damn roommate. But they don't. And this is the key. People are not behaving at a reasonable rate. In fact, the share of renters rate on rent in California has never been lower than it is right now. Same thing in LA. We don't have a crisis, and yet what do you hear? We have to have more rent control, right? We're going to put more rent control, and not just the state, but at the state level. Not just the city, but at the state level. What are we doing? We're going to put rent control in a place that doesn't need rent problems, needs more rent units. And we're going the exact opposite direction on the basis of crises that exist. Now, how do we get into these weird places where we believe things that aren't true? I've gone through this in the past with folks, and we don't need to go through everything again. Check out Thinking Fast and Slow, Daniel Kahneman. He points out that a lot of our thinking is not the kind of rational, deductive reasoning. He points out that we use our type 1 system, which is incredibly fast, it's incredibly efficient, but it's also based on emotions. It's based on heuristics. It's simply bad. It's based on pre-existing biases, not on anything resembling neutral analysis, as the case may be. And then, of course, The Rector's Mind by John Knight, another fantastic book. In this book, he points out, and then it comes to particular decisions, issues like care harm, liberty oppression, sanctity degradation, authority subversion, or our brain has evolved in very specific ways that these become emotional issues. It isn't just that your type 2 system isn't actively dealing with these. When it comes to a particular type of social issue, it raises our emotion. And when your emotions get raised, Your type 2 thinking gets shut down. Type 1 just says, shut up, I'm in charge here, right? And we've all had these arguments with our parents. And it's like you're talking to a wall, right? There's no communication there. And that's because both people are discussing these issues from a strictly emotional standpoint. And we're just not being reasonable to get everybody does this. We don't say it as much as we think. We think that is the biggest problem. You warn what this is a whole bunch of people going up an escalator to get 24-hour fitness. We don't think as much as we think. And I'm going to tell you that this is probably one of my favorite. I think I showed this to you last year, but it's worth going over it again. It's a Federal Reserve survey. They asked a whole bunch of people, how are you doing financially? Right? How are you doing financially? Good or bad? What's interesting is most people today, about 73% said they're doing fine. Back in 2017, 74% said they were fine. Now, I'll tell you, people are better off today than they were in 2017, but that's okay. Human beings are inherently unsatisfied. That to me makes total sense. People feel fine. What's really interesting here is when they ask, how is everybody else doing? And this is, how are people in your communities doing, and how are people in the national economy overall? And look how these numbers go down. Only 29% of people out there are okay. Now understand what this is telling us. The average person thinks they're doing just fine, but the average person thinks the average person is doing terrible. It doesn't work like this. I point out to folks all the time that 90% of parents think their kids are above average. Doesn't work like that. I have 2 kids, and you guys know this, I got a 7 and a 9-year-old. I like to point out, statistically, one of them will be a dumbass. That is how it works. It's the younger one, by the way. Affluent, but he's gorgeous. He's going to be just fine. But yeah, that's how it works, but this is our world. And of course, you think about, how do we got this weird place where we operate now? Well, a lot of it goes back to, of course, the insanity of the narrative around the pandemic that was going to cause a depression. It caused Jerome Powell to love $5 trillion and an $800 billion hit. The pandemic cost us $800 billion. And yet we've put $5 trillion of money at it, at the economy. That violent reaction set off the financial bubble, set off, of course, the crazy growth in spending. It set off, of course, inflation. Because when you cause enormous increase in demand and enormous increase in money supply, inflation is going to happen. One of the shortest cliches is inflation is a consequence of too much money chasing too few goods. Period. How many times did you hear over the last 5 years, households are being crushed by inflation? But that doesn't make any sense. If households were being crushed by inflation, demand would tumble. And if demand tumbled, prices would stop inflating. See how that works? It doesn't, but again, we don't think that way. It's strictly emotional. High inflation refinances work for 65% of Americans. So who should Trump benefit the big election win? Well, keep in mind that one of the primary issues coming in to this election was a deflation. So in a very real sense, why did Trump win? Because Jerome Powell. Because he's the one who made that choice back in 2020. That upset everybody so much in 2044 that ushered it back into office. And I just love the delicious irony of the fact that he wants to get rid of this guy. He should send him flowers and a candy, a little thank you note. No. Here, with that said, Trump is here, and it's been a hell of a few months. Now, I just give you kind of the underpinning of where we are. How do we think about Trump? How do we think about his impact on the economy? Let's start with labor supply issues, right? We saw the ICE raids. They were here in Los Angeles. Now they're up in Sacramento right now. Why are we doing this? Well, these people are undocumented. They shouldn't be here. Okay, I get it. They broke the law. They shouldn't be here, technically speaking. But that said, do we not also appreciate one of the biggest challenges in our economy today is the lack of people? Look, 25 years ago, birth rate started to drop, and as a result, the labor force growth is incredibly paltry right now. A few years ago, a bunch of really smart economists got together and said, you want to make the economy grow faster? Let's have more workers move here. Now, of course, back then, they were talking about fixing the legal system. We never did that. The folks continue to come here in an illegal fashion, over the border in an uncontrolled fashion. And guess what? That's not a good way of doing it. I get that. It's terrible for the people. It's obviously unsafe for us because we don't have any control. But the simplest way of taking the pressure off the border is to increase the legal system to move here. We're not even having that conversation, right? Not even close to it. You want to know how poor the immigrants are of this economy? Consider this. They just have some updated numbers here. If you go back to 2010, 15 years ago, in 15 years, this nation has added a little over 17 million new workers. 17 million new workers in 15 years. Almost 10 million of those 17 million people, well over half, were born overseas. Wow. Can you imagine how tight labor markets would be right now if these people didn't come here? And yet, Washer boasted the economy boring. Immigration secure easy. And immigration named top U.S. prompt for third straight month. No, it's amazing to me that we just can't have a standard conversation about this. And to be clear, whatever your feelings about the millions of people who are already in this country, whether you think they should all leave, Stephen Miller, or whether they should be given citizenship as long as they have a clean record, as most human beings think. You know how you're not going to deal with this? By sending ICE agents on Gestapo raids. They came to Los Angeles. How long were they here? A month. How many millions of dollars did they spend? How much economic damage did they do to town on Los Angeles? Do you know how many people they arrested? 2,800. Estimates of documented population in LA County range from like 500,000 to 750,000. They spent millions of dollars. They hammered the downtown LA economy. They broke civil rights across the board, and they arrested less than 3,000 people. Can we all agree that whatever your view on immigration is, this is not a solution? And of course, by the way, Florida and Texas have a higher share of undocumented workers than California does, mainly because a lot of our undocumented people, because high housing costs, are moving to Florida and Texas. Yet they're not going there. So, the spectacle is interesting. Now, they're not going to get rid of people this way. But that's not the scary part. The scary part is preventing people from coming here. I look at immigration into the United States during Obama's last 4 years and during Trump's first 4 years, and the difference between the two phases of immigration are very clear. If we stop immigration, we are basically at peak labor force right now, and things are beginning to get worse. And given all that government debt we have, it probably is not a good way to go. So clearly this needs to be fixed, but we're not doing it. Now, what's interesting is while we don't have any labor force growth, you know who does? Canada and Mexico. Because when it comes to immigration, Canada's all in. And when it comes to having babies, Mexico is all in. And the result of these two things is both of these nations have had twice the labor force growth we have had over the last 20 years. Twice! And that's why when back in 2017, we slapped the tariffs on China, which we absolutely should have done. That was a right thing to do. We didn't see onshoring. We saw nearshoring. Where did manufacturing operations go? They went to Mexico. They went to Canada. Because that's where labor force is available. It is cheaper to produce our parts in Canada and Mexico because of the regulators of life. So what are we doing? We want to slap tariffs on Canada and Mexico. Why? Because we want onshoring. But understand the bizarre nature of what we're doing here. We're trying to bring back manufacturing jobs while we're getting rid of workers. What are we thinking? You want to talk about narratives versus reality? This is one of my favorite quotes of the last few weeks. 80% of Americans say the country is better off if we have more manufacturing jobs, but only 25% want one. Now, where are we on tariffs? We have another deadline coming up. It's deadline after deadline after deadline. You probably see you probably will see the taco trade, right? Trump always trickles out. And that's why, even though he's crediting getting in more deadlines, Tomorrow just continues to go up because no one thinks it's real anymore. I don't know what it's going to be. But you know, the key here is actually it doesn't mean that much to us. If our economy is relatively steady, we're fine because we're not that import dependent. If you had a 20% across the board tariff on products coming into the United States, okay, 20%. Understand, we imported about $3.3 trillion of stuff last year. So even if we just paid the tariffs, forget about it, just pay it. You're talking about a $650 billion tax on the American economy. $650 billion. And that's kind of the numbers we're seeing. We're already running a couple $100 billion on the basis of tariffs. What does that mean for the U.S. economy? Not much. Right off the bat, over a third of that will be paid by foreign exporters. The rest of it, a little maybe 60%, will be paid by American consumers, American businesses. Say American businesses pay for, I don't know, half of that. We'll call it 30%. Well, that's roughly about $2 trillion, about $200 billion. Well, disposable personal income of American households right now is $21 trillion. $21 trillion, $200 billion tax? Nah, it's nothing. Now, don't get me wrong. It'd be bad for the auto industry. It's certainly bad for certain industries. Or for the most part, it isn't that big of a deal. In fact, a lot of analysis I see said if they get a 20 to 25% tariff across the board and everything coming to the United States, it would only increase consumer good prices by about 2.5%. That's it. So honestly, yeah, we can handle this. It is at the end of the world. That's not the issue. What is the issue? The issue is the environment at which we're attacking the rest of the world. But the problem here is not that the U.S. economy is so weak that we can't handle this. The problem is the U.S. economy is overheated. Household finances, these are too strong. And they're too strong because of course, government deficits. Look at the numbers here. We have an overconsumption problem. How do I define that? Our U.S. trade deficit is not $1 trillion per year. That is to say, we are consuming $1 trillion more than we're producing. That is not sustainable. The only time in percentage terms of trade deficit was worse was back in 2005. That's kind of a scary number. And again, this is all driven particularly by federal deficits. Enormous federal deficit, about $2 trillion last year. Our deficit is 6% of GDP to full employment economy. It's never been that big, and it's a spending issue for the most part. Big increases in spending, both discretionary and non-discretionary, pushing those numbers up. And we're not taxing for us. We're just borrowing and spending, borrowing and spending. You want to see it in a slightly different way. Think of this. Right here are two lines. This is the household savings rate. I showed you that number a little while ago. This is the savings rate when we include government borrowing. Suddenly, the true household savings rate is not 5%, it's negative 5%. And same thing in terms of household debt. If you just look at household debt, that's falling. But you know, we don't just owe money for our creditors. We are all collectively responsible for federal debt. You throw that in, and guess what? Overall debt to GDP ratios are actually near 200% once we include public debt. That's a much scarier number. And you start to recognize we're borrowing lots of money. And of course, the middle of borrowing all this money, well, now we have the big, beautiful bill, which is going to borrow up even more. You get right down to it, the numbers are very clear. This increases federal deficits by about $3.4 trillion over the course of the next decade. Now, one thing to be a little bit aware of is $3.4 trillion was from baseline. And the baseline, yes, trumps tax cuts going away. So in other words, we were scheduled to be closing the deficit. Now we're scheduling to continue to increase it. So it's not like it's $3.4 trillion on top of a growing deficit. It's that we're going to continue to grow the deficit. And it does a bunch of other little stuff in there as well. If you're in affordable housing space, they have the resource tax credits. If you're a real estate, they have advanced depreciation for manufactured. So there's all sorts of little gifts and gimmicks in there as the case may be. Oh, by the way, they're also throwing 10 million people off Medicaid. Oh yeah, there's that. Now, here's the key to this whole thing. We're in the midst of borrowing money like crazy. Where is our money coming from? And the answer is from the rest of the world. Right now, we have an enormous trade deficit, which is another way of saying there's an enormous amount of money flowing into the United States. Gassy 1 for 1, okay? Most of the money coming to the United States right now is what we call hot money, is portfolio investing. They're coming in to buy stocks. They're coming in to buy cryptocurrency. They're coming in to buy liquid assets. It's not foreign direct investment. How much are we talking about? When the last almost 2 years, we're talking about almost $1 trillion a year. Half the government deficit is being paid for by foreign money coming into the U.S. economy. Consider that, half. Why is this money flowing here? They're not trying to buy government debt. They're buying equities. They're buying crypto. Right now, the U.S. stock market has a 50% share of market global capitalization. The only time it's been that high was in the run-up to the tech recession during that crazy stock market boom. This is why, for example, the U.S. dollar was recently at a 40-year high because of the flow of money coming in. But again, they're coming in to buy our stock market, they're coming to buy our crypto, they're coming to buy bonds. They think they're buying this wonderful yield, but it's a bubble. And of course, in the end, the money is just being siphoned off, and through fungibility is being used to pay government debt. Yes, this is a bubble. Look at PE ratios. Look at cryptocurrency, $120,000. By the way, if Bitcoin is a little too expensive at $120,000, may I suggest investing in Farcoin? But by the way, it's not a joke. There is a Farcoin. It's going to triple the value, by the way, over the course of the last 6 months as I started talking about it. It has a market capitalization. It's much less. It's not $1 trillion. It only has a market capitalization of $1.2 billion. Farcoin. I mean, is this real? Of course it's not real. And yet, what are they doing? We now have stable coins. What are stable coins going to do? Stable coins are going to take money for people buying crypto, and they're going to be able to buy treasuries with it, which is another way of taking foreign money and pumping it into government debt, which made it feel wonderful in the short run. But what happens when, if you will, the veneer wears off? What happens when people realize they're viable rebellion assets? You know, if I want to get an external view of the U.S. economy, I actually look at Al Jazeera. I don't know if you've been to their website. They're pretty balanced. They're pretty steady. They have a reasonable view of the U.S. economy. And I can't even tell you how many articles I've seen in the last 4 weeks where foreign global investors are going, we're overexposed to the U.S. That's the key. So it isn't so much that there's a problem in the United States, but when this money turns off, who's going to have to fund the government deficit? And the answer is you and I. How is that going to occur? Through a big increase in interest rates. And we saw this recently. We saw it earlier in the year. This is why I got scared in the second quarter of the year, because we had the big threats for tariffs. The stock market started dropping. In the short run, the bond market started rallying as it typically does, and then something changed. Suddenly, the dollar started to drop, and the bond market started to drop, and interest rates started to go up. Now, in the end, Trump backed off, everything stabilized. The dollar is still kind of drifting down slowly, but you could see the impact. The financial market sell off rapidly, the dollar drops, interest rates go up, and that's going to create a whole secondary hit to the U.S. economy. And this is what you have to worry about. This is the issue. So right now it feels good, but we are clearly taking a long walk down a short fare. Period. And Trump seems to be trying to get us to jog as opposed to walk. Where is it vetted all this? Absolutely nowhere. They're between a rock and a hard place. There still is inflationary pressures. And if the dollar starts to drop, that's going to make it increase. And what's interesting here is they're not doing anything because there's nothing they can do. Look, if they actually drop short-run rates, you know what that would happen? That would cause the dollar to drop because it's something called uncovered interest parity. The dollar starts to drop, that pushes longer rates out. So you can't use short-run mechanisms. Typical mechanisms. They're just trying to solve. And of course, what Trump is saying, cut short-run rates, cut short-run rates, cut short-run rates. Well, the one thing that's going to do is expand the yield curve. It's not going to do what he thinks. And so you have Powell put himself in this horrible position, sitting there, just frozen like a deer in the headlight. Until when? Well, in best case scenario, he's gone in May of next year. They bring in Bassett, Mr. Stock Market, 36,000, and he starts cutting rates. And that will expand the bubble even more so. And we just keep pumping and pumping and pumping. At some point in time, the bubble's going to burst. This is, understand where Trump started with this economy. And it's such an interesting dichotomy. He inherited the healthiest set of American households ever. And yet everybody's pissed off and angry. And then you look at our actual accounts, you look at our external accounts, enormous trade deficit, the federal debt. You would think foreign investors would be terrified, and yet the dollar's strong and the stock market's at a record high level. What a weird world. Financial markets are thrilled, they should be scared. American households should be thrilled, and they're angry. None of this is sustainable. It's as simple as that. But how it ends, that still remains to be seen. Clearly, risks are growing, but we're not there just yet. Strong economic momentum, we're in a good second half of the year. The turbulence, yes, is threatening inflows. Will it be enough? I don't know. You may calm down again. You may see us going right into the next year. If you want to pay attention to a number, pay attention to the dollar. The dollar is the most important number to vary. But the dollar starts to drop, things are up. California, our state, is just continuing to focus on all the wrong areas. It's not housing supply. It's not housing affordability. It's housing supply. It's not income inequality. It's labor supply. These are the things we need to worry about. And we're not. We're too busy having existential panics for crises that don't exist to sit down and do the basic things that need to be done to help our economy grow at a decent pace. As for real estate, the issue is one of interest rates. I've been saying over and over, they're not going to come down. If anything, they're going to go up again. And that's what the industry has to be thinking about, has to be facing. So the banking systems, credit unions have to be thinking about. Interest rates are going to go up. And yeah, that's going to be a bit of a problem. But in the end, the real issue is the narrative. Our narrative are running amok. And there's a lot of the reasons for that. And I think that someday we'll figure this out. I don't think the end is nigh. But I would say this, that we live in a time of too much information. And we got to figure that out. And I think we will. Human beings adapt. We'll figure it out. But we hope we don't tear the place apart in the meantime. We got to figure it out quicker rather than sooner. Because, as again, the wisdom of the ages have said, it is easier to fool people than you miss the day that been fooled. For example, Mark Twain would never actually study. But he did now. So with all that, that's the big picture. I realized it was a lot there. I think I talked a little on, but hopefully we have some time for Q&A.
Absolutely. Thank you, Dr. Thornburg. Very